Hello and welcome to this week's episode for Conservative ETF Investor. I'm your host. My name is Ken, Senior Stock Market Analyst for Conservative ETF Investor. And this is the update for February 15th, 2025. We do have a green on the stock market strength color signal. Here is all the video content that we are going to go over for today's video. As of today, February 15th, there is a 97.5% probability that the Fed, Jerome Powell, on the announcement of March 19th, is going to keep the rates, the interest rates, the federal interest rates where they're at right now. So no movement for the next meeting, 97% probability. Last week, the S&P 500 gained 1.49%. The NASDAQ 100 gained 2.91%, and the small caps IWM was down 0.01%, so basically flat. The bottom line is that there's weakness in small caps, there's strength in the technology NASDAQ 100, and there's good growth happening in the S&P 500 for last week's action. Last week, we did send out 2 trade alerts to our subscribers. Now, I do manage 4 portfolios. I only share with you, the audience, 1 portfolio, which is the SPY portfolio right here. Now, the first trade alert went out on February 10th, right here at 12:23 p.m. Pacific Standard Time. And here is the information that we did. We were in cash, and the market was moving up. I noticed it, so I pyramided into the position with a 50% position, bought 100 shares at the market. The market was continuing to look strong. So again, on Wednesday, February 12th, at that point in time, here is the alert that was sent out. 2/12/25 Conservative ETF Investor trades. The market is refusing to go down on bad news. We need to be long. I'll get into that bad news in a second. The only index falling behind is IWM small caps. We know that. We just saw that just a second ago, how it was flat for the week compared to the other indexes, which were up. We will buy 50% more shares in SPY and QQQ, but we will not buy any more IWM yet, small caps. Why? Because I wasn't sure which way it was going to go. The market isn't as favorable to small caps right now for some reason. So the order was buy at the market 100 shares of SPY. We also bought the NASDAQ 100. SPY is trading at 603, and the cubes were trading at 528.45. We will not touch the small account. I also have a small account that has an account value of about $3,500 that I manage and send out those alerts to my subscribers. Okay, we do have a position in Google, and I bought it before the earnings announcement with the expectation that it was going to bounce. But it did bounce, but in the wrong direction. So we're upside down on that position. I'm watching Google. It seems to be flattening out, and I think it will pick back up. So I'm going to continue to monitor Google. It's one of the Magnificent 7 stocks, so it should come back up. It's just a matter of when. All right, now we are looking at a 10-day candlestick chart for the S&P 500. And in the last 5 trading days, I've got over here my trade announcement. So here on 210, this is where I said, let's go ahead and buy 100 shares at the market of SPY. Now, that was on a Monday, which was the 10th. On the 7th, which was a Friday, look at that candle. Now, the previous week's candle, which is out of this picture right now, that was also a red candle. And then on Monday, when we opened down, way down here. So I wasn't sure if this Monday was going to be a gap down. This Monday was not a gap down. So this Monday, because it was not a gap down, the market looks like it was moving sideways to, I think, was going to go up. I said, let's go ahead and buy 100 shares. Let's see what the market does. So we did. We bought 100 shares. Then I watched the market until this day right here. Now, one thing I want you guys to notice. You notice how the color of this candlestick is a black outline, black outline, black outline. All of these are black except for this one and this one. So what happens is on the red outline, this is where the market opened here, which was lower than the previous candle's close. That's why it's got the red outline. But then the market refused to go down. This green line here, that one is the 50-period moving average. We almost touched it. For all intents and purposes, you can say we kissed it. But it's very close to the 50, right? The market did not want to go below the 50. You can see that right here. And the market refused to go down. And here is the news that I wanted to share with you all. So this is from the Wall Street Journal. And this is on the 12th, which is the same day as that day right there. Let me just clean this up just a little bit. So on the 12th, the Wall Street Journal says, stock market news, February 12th, 2025, the Dow, the S&P 500 fall after inflation hits 3%. What does the Fed want? The Fed, Jerome Powell, wants 2%. We're at 3%. What does the market want? The market wants the Fed to cut interest rates. Well, the reason why you would cut interest rates would be to help stimulate the economy. If you've got hotter than expected inflation, the Fed cannot be cutting interest rates. If anything, they should be raising interest rates to slow the economy down to get that inflation at his mark, 2% or thereabouts. He's 3%. He's not going to allow the market to stay at 3 or continue to go higher. He's going to be not cutting interest rates. He's going to be raising interest rates if that were to happen. So from that perspective, it's bad news. But the market, even with that information, refused to go down. So it's considered bad news. You have a market that's not willing to go down under bad news. Well, once you get some good news, what's this market going to do? It's going to do nothing but take off. So obviously we need to be long this market, which we are. We are currently long this market. Now, here's an interesting thing. Look at Friday. Friday closed at 0.00%. It closed absolutely flat on the day for the S&P 500. And of course, we use the ETF to represent all of our indexes. Okay, this is all the trades that we've made in calendar year 2025. And you can see that our current portfolio for SPY is up 2.54%. Our whole goal here is to beat the returns of the buy and hold investor. Their returns for the S&P 500 is 4.03. So we are not accomplishing that goal. We recognize it. We acknowledge it. We are going to work in an effort to beat that before the end of the calendar year, just like we did last year. All right, so we do have 2 open positions, which are highlighted here in yellow. They're not closed out. These are all of our closed out positions right here. If you want to sign up to receive real-time trade alerts, you can head over to this link right here. There'll be a link for it down in the description down below. Also, I want you to go ahead and smash that like button down for me right now. Subscribe to my channel and ring that bell. All right, now we are looking at an equity curve of our model portfolio in blue against the S&P 500 buy and hold investor in pink. Our goal is for the blue to be above the pink. We know it's not, but we want to see how we're doing, and we want to measure that across the benchmark. So many people who put their information out there on the website about what the market is going to do and this and that, they don't go into this type of a detail that shows you how they're putting their money, how they're doing compared against a benchmark. All of these things are critical to determine your portfolio performance. It's not just one trade. It's how is your portfolio doing? And that is what we are trying to do here at this channel. Okay, so you can see here last year in 2024, this strategy produced a return of 37.29% against the buy and hold investor who closed the year out at 23.3%. All right, now we are looking at a weekly chart for the spiders, candlestick, 1 year duration. Now, you can see these trend lines I've got drawn here and here. So that would be a flag formation in a bull market where we kind of go up, we come down into the flag, and then we eventually break out of the flag, which we did here on this candle. I've got it overshadowed by that marker indicator that I have drawn in there, because what I did was I took the distance, let me clean this up. I took the distance of the wedge from the highest point here, and I brought that over to when we did the breakout here. That should take us to an expected return, which looks like it's somewhere around 625. Okay, so right now we're looking for a target for the S&P for the spiders to hit about 625 before we start reaching a pullback. Okay, so we're going to stay long in our portfolio until that target is met. Hopefully, we'll see what the market does between now and then. And then once that happens, we're going to start doing things to protect the portfolio while it's during a pullback phase. It's during these times in which we can inch forward to produce our returns greater than the buy and hold investor, because we're not just strictly buy and hold. We actually take steps in an effort to profit when profit is to be made and to protect when it is deemed necessary to protect the portfolio. And we'll go through all that as we look at the charts. Okay, so I do have here the bull symbol because this chart is representative of a bull market. Now, on the MACD, it is below its signal line, but it looks like it is getting ready to curl up and pass its signal line. The slow stochastics down here is already above 80, above its signal line, and traveling sideways. Still, because of the market action, because of the breakout, because of the target, all of these things represent bull market activity. Okay, now we're going to look at the spiders daily candlestick chart with the duration of 6 months. So you can see the candles in the chart really well. We do have some moving averages, simple moving averages, as well as EMAs, exponential moving averages. If you don't know what this terminology means, just do a search on YouTube. There'll be somebody on there that will explain what this means, okay? And this is what's filling into the chart in the background of our candlesticks. Now, I do have in here a couple of trend lines. This one here representing support. This one here representing resistance, where we could not break through it, Kind of touched, danced around it, but didn't really get through it until 2 days ago on that candle. Do you see how that candle, let me clean this up really nice. You see how that candle did something that nobody else could do for a little while here, and that is the breakout. That is the breakout. Then the next day is the follow through. Are we going to hold, or are we going to tuck back in? We did not tuck back in. We held and moved sideways. Bullish activity, okay? Look over here at the MACD on this daily chart. On the MACD, you are above the signal line traveling north. Slow stochastics came from a reading below 80 above its signal line and heading north. All of this activity, the breakout and everything else. Oh, down here, cycle brackets. Do you notice? I think this low right there is that low right there. If that's correct, this new cycle bracket that we're in is going to produce upward energy like this. We are in that rising upward energy phase right now to take us to that 625 target level. We are long the market. I showed you how I'm invested. We're going to, if all of this comes true and the market plays ball, then we are going to make some bankroll, which is our whole goal. We don't just come on here and talk about the stock market just to talk about it. We actually want to make a return on investment, okay? So, and hopefully all of this is going to pay off when we hit that target of, at this point in time, 625 or thereabouts. As we get closer, we'll hone in more on that. All right, now we're going to look at the VIX which is the volatility index or the fear index. And where are we at? We are in the ultra low range. What happens when you're in the ultra low range? The market goes up, folks. So now, the only part, I was studying this closely earlier, I want you to notice this. Notice how you're in the ultra low range, bam, you come up. You're in the ultra low range, bam, the thing spikes up. You're in the ultra low range, bam, it shoots up. And now we're back there. So I'm thinking that we're going to get a little bit like that and then back down there. But during that time frame, I'll expect some volatility in the S&P 500, but I will not be expecting any severe corrections or any severe pullbacks, something that's really a damaging portfolio pullback. Let's put it that way. I expect volatility. It's going to go up and down, but I don't expect a damaging portfolio move by the S&P 500. At least that's what this chart is telling me. That's why there's a bull symbol here. We need to be long the market now, according to what this information is telling us. Okay, again, another bull symbol. What are we looking at? The New York Stock Exchange advanced declining issues. All right, now the chart that is the AD advanced decline line is going to be the one that's in red and black. We have Bollinger Bands, okay, that are in green. Those are the squiggly lines that are enveloping our target that we're trying to monitor here, which in this case is the New York AD line, okay? So, and generally speaking, on the Bollinger Bands, you're going to bounce in between. You're going to go to the low, go to the high, and then depending upon what the market does, it bounces around. Like here, you can see the AD line came up and kissed the top end of the Bollinger Band, and it just kept hugging it, came down a little bit, came back up, hugging it. So right now, we are at the top of the Bollinger Band. And generally speaking, to get up there, you have to be bullish. Otherwise, if you're at the other end of the spectrum, the lower end of the Bollinger Band, you're showing more weakness. So the market is showing strength. We got the bull symbol right here. The MACD on the advanced declining issues. Look at this, how we came down, kissed the signal line, bounced off of it, and we are traveling north. Slow stochastics above its signal line, traveling north. Bullish, bullish, bullish. Now we are looking at TNX, 10-year U.S. Treasury yields. That's the candlestick chart. In dark blue, that's the spiders. In dark black, that's TLT, which is an ETF for 20-year bonds. That's the black. That's TLT. The TLT is going to move in the exact opposite direction of TNX. If TNX goes up, TLT goes down and vice versa. So we just want to see what's going on. I said before we were in a trading range between right here and right there. We are still bouncing in and out of that trading range. The market seems to be okay with this current range that we're at. The blue, which is the S&P 500, you can see it's kind of moved sideways. We know we're breaking out because we just saw that. So if anything, we are bullish. Now, another thing that's bullish here, look at this on the MACD. Look at the thumbnail, how the MACD came up, tried to break its signal line, did not break the signal line, bounced and came down and is now putting further distance away from it and the signal line. That gives you evidence that what's happening here is that the TNX is not going to be going up, but it will be going down. Well, if TNX goes down, what happens to equities? It becomes more attractive to investors because the yield that investors could get in safer investments is going to diminish. So that hungry investor who wants that rate of return is going to go into the stock market in order to get it, because they're not going to get it through fixed investments. That will only help us. Slow stochastics, same thing. Below its signal line, traveling south. Bullish. The chart is showing bullishness. We are long. Another piece of evidence to show why we are long. All right, there is the man himself, Mr. Warren Buffett, the Oracle of Omaha. Over here, CNN Business Fear and Greed Index. We are at 44. We compare that to 1 week ago, 38. We know that fear is we're going from fear in getting close into neutral and then going over to greed. When you're in the neutral territory, you really can go either way. So I've got it down here, the bull and the bear and the bull symbol to represent that this market could theoretically go in either way. You always get contradicting information when you're looking at the charts. What we're trying to do is we're trying to take the sum of the evidence to make a determination in our mind of how we should be positioned at all times. Now we are going to look at seasonality for the spiders. We're currently in the month of February 2025. I've got down here a bear symbol. What? A bear symbol? Why do you have a bear symbol down there? Because using 5 years of data on a seasonality basis, the S&P 500 has only a 40% probability of closing higher. That means there's a 60% probability of closing lower. Where do you stand for the month? For the month, we are up 1.31% with a 60% probability between now and the end of the month of closing below that line. So from a seasonality basis, we are bearish because that's what the last 5 years of data have proven to be. So 60% is only 60%, meaning there's still a 40% probability we are going to close higher. Maybe this is that 40%. Again, some of the evidence. Oh, one thing I want to show here on this chart, which is really good. This is a monthly candlestick chart. Trend lines, resistance and support, very important. You can see that in the current month, we came down and we were at that support line. If this support line holds, which it currently is holding, we would expect to come over and tag this resistance line like we have done many times in the past. Now, we did not do it in the month of January, but we did do it in the month of December, which was even a red month, but it still tagged that upper resistance line. We want to watch this. If we do indeed tag that upper resistance line, we want to see where that takes us. Is it going to take us to the 625 or some other number? It's a little difficult to tell because of the way we're at the top end of the scale here on this chart. But as we move closer, the chart will reveal itself and these numbers will reveal themselves. If we tag that line, we're going to take steps to protect our portfolio. You bet your bottom dollar we are. All right, now we are looking at a Thinkorswim platform, Spider's 3-year weekly candlestick chart with standard deviations +2, -2, +1, -1, regression, dashed green. What is happening in this chart? You can see I've got a few different alerts because I want to know exactly what is going on. I do have this dashed blue line, which is a valid trend line taken from this cycle low here to this cycle low right there. And that is totally valid. And we came down close to it over here, did not breach it, and then went north. For a bull market to remain a bull market, we need to stay above this valid trend line. And we are above it. Now, I do have, just in case things start going sideways, I did show how we had a rising wedge pattern. We broke down below it, and I put a projected target rate, which would take us over to here, about 540, which, of course, we never did reach that 540 level. We continued to go north. Until we start breaking out, making solid new highs here, I'm just going to leave that in. Most likely, that will not come true. I do not see this happening in our near future at all. But just in case, you never know what's going to happen. The market is unpredictable. Just in case it does come through, we'll leave it up there for now. We'll take it off if we start making stronger new highs. Right now, you can see that we're kind of in a sideways pattern on this market. I do have lows, alerts on my lows, and I do have alerts on my highs, just in case we start breaking out and I know exactly how to trade the portfolio. What I'm going to do is I'm going to get rid of this and we're going to switch over from weeklies. Let's go to 1 year daily. let's go to 1 year daily on the cycle brackets and let's get a little bit closer look as to what's going on here. You can see the alerts that I have coming to myself. First one is going to be set at 621. The next one is at 631. So we'll see if we start coming up into that level right there. Now the 621, you notice the distance from this cycle high to the next cycle high was about 2%. Here to here, about 2%. So I took this cycle high here, went up 2%, and that took us to about 621. So that would be the first level that this market might showing signs of a sideways to pullback action, because that's what it's been doing as of lately. The market does look a little bit stronger, so I got that 631 mark in there. 625, I was just guessing at that number, but it's about the halfway point even between these two. So these are good numbers to be looking at. You can see here in my notes as of today, February 15th, sideways to up action is expected. Now I do have drawn in here this line, and you notice that we don't have a good breach of that line yet. We did breach, I showed you earlier how we did breach this trend line that was coming this way. We did breach that 2 days ago, but we haven't breached this line yet. We do, for this market to continue to be a bull market, it does need to breach that line, and it needs to go above it, hold and stick. And then we're on our way for a few more percentage points gains before we pull back. Now, I do have my cycle brackets of my major and minors down here, and I'm thinking that this low might be that low right there. If indeed that is a true statement, you have the major and minors both giving you upward action right now to carry that through and tag at least the 621, if not the 631 right now. We're not in the summer, we're still in the winter. You do have what's called the summer doldrums. Sell in May and go away. These are part of the songs of Wall Street, okay? We're not there yet. I'm hoping that before the summer doldrums kick in, we're going to tag these lines right now so we can get some profit out of this market. I hope that happens. But we're prepared for whatever happens to this market. We're prepared to trade and position ourselves appropriately. Right now, I think we are positioned correctly. Down here, you do have the MACD above its signal line traveling north, slow stochastics above its signal line traveling north. All good and bullish activity from here. All right, now we are looking at an Excel spreadsheet that I created. This is fresh data, February 15th. At the top here, you have asset classes. At the bottom section, the 11 S&P 500 sectors broken down per sector. We monitor this to see the health of the various asset classes and the sectors. The best number you can get on this information on this chart is a 6. Anything with the 5 or a 6, I give it the color green. If it doesn't have a color green, it's not as strong. The more green on the screen, the stronger you are. A couple things we want to do. Number one, we want to compare last week's reading of 57, which was a yellow, into this week's reading, 61. That takes us, according to our cheat sheet down here, into the green for asset classes. That's new. Last week yellow, this week green. Getting stronger. At the 11 sectors, last week 41. This week 62. 62 is enough to get you in the green. We have 2 greens. Again, see the bullish symbol? The chart is telling us that we need to be long. This is bullish information. All right, that is going to take us to the conclusion of this video. As of February 15th, 2025, market summation, according to me, Ken, Senior Market Analyst for Conservative ETF Investor. This market is getting stronger, as noted by the new green signal. Okay? We are 97% invested in the market going long. Of course we are. Our plan is to stay here and watch the market action. The expectation I have is for the market to move sideways till the end of the month and then resume an uptrend. Now, even though I say these things, what my expectation is of the market is an 800-pound gorilla, and the 800-pound gorilla will do whatever it wants to do whenever it wants to do it. So I always have that in the back of my mind. And I also have in the back of my mind Warren Buffett's #1 rule for investing: never lose money. But when you have your money in the market, you have to take on what is known as market risk. We're always looking at things from a risk to reward ratio. Is that risk of putting your money in the S&P 500 worth it? Is the reward worth the risk of you putting your money at risk? In this case, I believe it is. And that's why I'm positioned the way that I am. But it's not, you always want to be thinking and looking at the other side of the equation. Every time that you make a trade, someone's on the other end of that trade betting against you. Oh, and by the way, we as retail investors, we're betting against Wall Street. Wall Street has enormous resources. We cannot out-research Wall Street. Oh, another thing about Wall Street and the news and things of this nature. This is why I'm a technical analysis more than a fundamental analysis. If you just looked at the fundamentals, you'd be scared to death. With tariffs, new president, things shaking up all over the place, interest rates all over the place. If you're going to be a person of a sound, rational mind, you're not going to put your money at risk because of so much chaos going on in the world. But as a technical analysis and me looking at the charts, I can see that no matter what that external noise is that's going on in the world, the market is buying it up and they are going long because the market is moving higher. So that's why I like technical over fundamental analysis. Okay? And that's how that helps no matter what the external noise is. It doesn't matter. It doesn't matter what the earnings report is. What matters is how the market reacts to that information, that news, that earnings report, whatever the information is. And that is what I like to follow. Follow the money, okay? So basically, that is it. I hope you got some valuable information out of this video. If you have not done so already, smash that like button down for me, subscribe to my channel, and ring that bell. If you want to learn more about me and become a subscriber, you can head over to my website. There will be a link for it in the description down below. You can receive real-time trade alerts as I send them out. All right. I thank you and wish you good trading.